Just when Canadians were starting to breathe a collective sigh of relief, thinking the era of painful interest rate hikes was finally behind us, Scotiabank decided to throw an active hand grenade into our punch bowl. They've just dropped a bombshell prediction that the Bank of Canada won't just stop cutting rates, but will be forced to start hiking them again by the second half of 2026. While other banks are forecasting a period of calm, Scotiabank seems to think there's another storm brewing. So, what exactly do they think they know that everyone else doesn't? In this video, we're going to break down Scotiabank's shocking forecast. We'll dig into why their economists are swimming against the current, what other big banks are saying, and most importantly, what a return to rate hikes in 2026 would mean for your mortgage, your savings, and the Canadian housing market as a whole. All right, let's get straight to the heart of this. For months, the general hope amongst Canadians and the consensus amongst most economists was that the Bank of Canada would keep cutting rates or keep them low and hold them steady for a good long while. Forecasts from major banks like RBC or TD Bank have pointed out that policy rates settling around 2.25% through 2026 would be kind of normal. Some like BMO have even said that the doors are open for cuts next year of around a quarter point. Then Scotiabank's team decided to publish their outlook, and it completely flipped the script from what the other banks were saying. They believe that the rate cut cycle is pretty much over, but they didn't stop there. They're forecasting a 50 basis point or 2 increases in the latter half of 2026. This would completely reverse the most recent rate cuts we've seen. So the billion-dollar question is, why are they calling for hikes when most other predictions are saying stability or even more relief? And really, it boils down to a few key areas where Scotiabank has a much more pessimistic view of the economy. First, and most importantly, stubborn inflation. While the headline inflation numbers have cooled down, Scotiabank's team is looking at the nitty-gritty details, and they're not really liking what they're seeing. They point to sticky core inflation, strong wage growth, and rising business costs. They argue that these factors are creating significant upside risk to inflation, meaning they believe that inflation is a much more tenacious problem than the Bank of Canada and other analysts are letting on. Second, Scotiabank is reading the recent rate cut very differently. Most of us saw them as the start of a new, easier chapter for a stronger economy. Scotiabank sees them as a temporary insurance cut. In their eyes, these cuts were a precautionary move to prevent a worst-case scenario. Once the economy finds its footing, which they expect it will, the Bank of Canada will have to take these insurance cut policies away to wrestle inflation back down to that 2% target. Third is the impact of government spending. Both federal and provincial governments are talking a big game about massive investment projects. They know that if even a fraction of the money starts flowing, it will light a fire under economic growth and, you guessed it, inflation. All that government stimulus could easily force the Bank of Canada's hand, in Scotiabank's opinion. And finally, there's the odd couple, the labor market and productivity. Canada's job market, while showing signs of slowing, has been surprisingly resilient. When you get strong wage growth combined with our unfortunate and notorious weak productivity, you get the perfect recipe for inflation. As business costs go up without more stuff to actually sell, they pass that cost on to customers, increasing the cost of it, increasing inflation. You know where I'm going with this. So when you put this all together, stubborn inflation, these insurance cuts, government spending, and a quirky labor market, Scotiabank's logic seems uncomfortably clear. They see a future where the Bank of Canada's number one enemy is still inflation, not a sluggish economy. Now, before you run to lock in your mortgage for a decade, it's critical to remember that Scotiabank is the outlier here, and they've been the outlier before in their previous predictions as well. Most other major Canadian banks are painting a very different picture, and a much calmer picture for 2026. So let's look at why they disagree. The biggest counter-argument is simple. The Canadian economy isn't exactly a powerhouse right now. Even Scotiabank only expects a modest growth of 1.4% in 2026, which is consistent with the Bank of Canada's own predictions. Other banks like TD and CIBC see weaker growth and believe the economy is just too fragile to handle another round of rate hikes. Their logic is straightforward. The economy is sputtering, rising rates would risk shoving Canada into a recession, and that's a gamble the Bank of Canada is unlikely to take. Another huge factor is our southern neighbors. The US Federal Reserve is widely expected to cut interest rates through 2026. This is a really big deal. If the Bank of Canada starts hiking while the US Fed is cutting, the Canadian dollar will soar, A stronger loonie makes our exports more expensive, which could cripple our already fragile trade-dependent economy. Many economists believe the Bank of Canada's hands are quite tightly tied to the Federal Reserve and what they do with their interest rates. Then there's the "I'll believe it when I see it" take on government spending. Big promises on infrastructure are a dime a dozen in politics, but they often get tangled up in delays and red tape. The other banks are taking a more cautious wait-and-see approach. If that fire hose of government money never fully turns on, the inflation pressure Scotiabank is worried about could really not show up. Finally, some economists think inflation will just sort itself out. They argue that the worst is behind us and that the global economy and supply chains are normalizing themselves, causing inflation to naturally drift back down to that 2% target without needing more rate hikes from the Bank of Canada. TD Economics, for one, expects that subpar economic growth will be enough to cool core inflation, allowing the rate to stay put. And as we mentioned, some forecasts from BMO and National Bank even suggest other smaller rate cuts could happen and be on the table for next year as the economy really starts to struggle. So the consensus view is one of caution. It sees the inflation risk, but places a heavier bet on sluggish growth and a watchful eye on the US Federal Reserve. For them, the most likely path is a long, steady pause, and maybe, hopefully, a cut in 2026. Okay, we've waded through some very conflicting expert opinions. On one hand, you've got Scotiabank waving the red flag about rate hikes coming back, and on the other, you have everyone else in the industry saying, keep calm and carry on with things. That said, if you find this breakdown useful for navigating the noise, do me that favor and hit that subscribe button. We work to bring you updated videos that help you make financial decisions. And hitting that subscribe button really helps us grow the channel so we can create more in-depth content just like this. Now, let's get to the most important part. What does this all mean for you? So let's bring this down from the ivory tower of economic theory to the kitchen table. Whether Scotiabank is right or not, the forecast alone is enough to change the game. First, let's talk mortgages because, I'm a mortgage broker. This is where the rubber hits the road. If you have a variable rate mortgage or a home equity line of credit, a HELOC, the Scotiabank forecast is a direct warning shot to you. After maybe enjoying a little relief, the thought of rates climbing again in 2026 means your payments could start to creep back up or your principal payment could creep down, and it makes budgeting kind of a nightmare. And to be honest with you, might cause some people to have some PTSD. It can also create payment shock if you start negatively amortizing your mortgage. So what you want to do is really make sure you understand your variable, take a look at it, and make sure you plan accordingly. Whoever your mortgage professional is, call them, talk to them, and make sure you're still in the right product for you. For anyone with a fixed rate mortgage up for renewal in 2025 or 2026, things just got a little tricky. The old strategy might have been to renew into a shorter term, let's say a 1 or 2 year, and hope to renew again later at an even lower interest rate. But if Scotiabank is right, that strategy could backfire. Renewing into a 2-year fixed rate in early 2025 might seem clever, but it could mean you're renewing again in 2027. And that could be, if Scotiabank is correct, when there's going to be rate hikes and higher interest rates. The forecast will almost certainly push more people to consider longer term fixed rates, like a 5-year or a 3-year. And to be honest with you, I'm a big advocate for the 3-year over a 2-year anyways. 2 years just seems too quick for a mortgage and economics and all the things that involve interest rates. Next, we want to talk about the housing market. The entire Canadian housing market runs off the cost of money. The recent rate cuts started to coax some buyers off the sideline with hopes for a bit of a recovery in 2026, but it hasn't been that crazy. And Scotiabank's prediction throws a huge bucket of cold water on that party anyways. The mere threat of future rate hikes can be enough to chill buyers' confidence right out. If people believe that rates will go higher in the next 2 years, they're less willing to max out their budgets today. This could put a lid on price growth and lead to a more stagnant sideways market over the longer term. It kind of kills the odds of a strong rebound many were hoping for and keeps affordability as a number one problem. Now, lower house prices are good, but you got to remember, generally speaking, when house prices are down, interest rates are up. When house prices are up, interest rates are down. So finding that balance can be a struggle. Make sure to talk to your financial advisor, your mortgage broker, whoever, to get a good understanding of whether now is the time to buy or not. And finally, this hits savers and investors. For savers, the idea of higher rates down the road isn't all bad news. It could mean better returns on things like GICs or high interest savings accounts. For investors, however, it just adds that volatility. The stock market hates rate hikes because they can squeeze companies' profits and slow the economy. Rate-sensitive sectors like real estate, utilities, and even the banks themselves could face headwinds if the markets start taking Scotiabank's forecast too seriously. The bottom line, this forecast injects a bit of a heavy dose of uncertainty right back into the financial lives of Canadians. The era of predictable rock-bottom rates is long gone, and now even the path of rate cuts is being called into question. So we're left with two completely different stories from Canada's top economic minds. On one side, Scotiabank presents a compelling, if unsettling, argument. They say that deep-rooted inflation fanned by wages and government spending will force the Bank of Canada's hand, where they're going to have to increase rates in 2026. On the other hand, the consensus from other banks like RBC, TD, Bank of Montreal, and many others suggest a weak economy and a dovish US Fed will keep the Bank of Canada on the sidelines, leading to a longer period of stability and stable interest rates. So, who's right? Honestly, no one knows for sure. But we can watch the signs. The most important number to track over the next year will be core inflation. If it stays stubbornly high, that's a big point for Team Scotiabank. Also keep an eye on the job market and whether those big government investment projects actually get off the ground. If jobs stay strong and wage growth is there and there's a ton of spending starting, the risk for hikes goes up. If the economy weakens further, the long pause will likely be proven right. This forecast is a critical reminder that in economics, nothing is written in stone. Just when we thought the way forward was getting clearer, someone decides to redraw the map on us. It forces us all to be more cautious, to plan for a bit of chaos, and to stress test our finances against a future that might not be as smooth as we'd hoped. Now I want to know, what's your take on all this? Is Scotiabank being dramatic, or do they know something that no one else does? Drop your thoughts in the comments down below. Thank you so much for taking the time to watch this video. My name is Myles, Nowik of the Nowik Mortgage Team, powered by Andy Mortgage. We'll catch you on the next one.